baby, I am no longer the most bearish person in this market. In fact, even though I talk bearishly about everything, I'm still buying stocks. I still see value potential out there, and I've kind of advocated how to manage your finances and your cash to make sure you always have enough to take advantage when the market dips. But now the whole spectrum of influencers are showing up late to the party of me complaining and being whiny about how things are just getting crazy expensive. I mean, we got Jeremy here saying, hey, cash, oh my goodness, the most cash I've ever had since the 2020, insanity when I was just buying everything, but now's no longer a time to buy. Meet Kevin, oh my God, he's day trading his money, getting you involved in day trading now, because why hold companies long term when things are so damn expensive and bearish? Just day trade it. That's how you're gonna make your money in this market. I hate these guys. Well, Jeremy, I got some respect for. Meet Kevin is a whole nother spectrum of insanity that I cannot compromise with, because I live in the world of civility and long-term growth. But it is hard to recognize where the future is going to be when you got stocks trading at high multiples we really haven't seen since that pandemic-like era. Now, I'm going to break down how to navigate this, why the market could crash and not crash literally at the same time because of secular rotation, the fact there's so much damn cash sitting on the sidelines, there's so much stuff playing into a multi-trillion-dollar, tens of trillion-dollar economy that any fool that tells you he knows that the market's going down or up is just that, a clown. But I can recognize I am the king of the clowns because I can effing admit it, baby. So that is a conversation you'd appreciate. Hit that like button, because yes, if you play crypto meme coins, you're going to go to the moon, baby, because that's what Reddit is telling you right now. I mean, we saw the Reddit IPO, and the stock has been incredibly volatile over the last week, trading up 50% after dropping on IPO, skyrocketing. Now anyone that bought the top is, going to see how good their diamond hands are these days. But there was a great channel out there called New Money. And before I kind of ream into these companies, because I own a lot of these companies, I'm buying a lot of these companies, just take a listen, because I think this is just relatively intriguing.
But what I did for this example is I imagined for each of the Magnificent Seven companies, as of today, they'll be able to grow their earnings at 12% per year for literally the next 10 years. And then for the discount rate, I used 15%, because as I always say, if we're asking for any less than that per year, what's the point? May as well buy an index fund. And then for the terminal value, I multiplied the 10th year free cash flow by the average year-end price to free cash flow multiple of each business over the last 10 years. Now, to my surprise, 2 of the businesses turned out to actually be slightly undervalued, with no margin of safety, that is. But as you can see, 5 out of the 7 all turned out to be pretty egregiously overvalued. And when you zoom into Nvidia, the results get pretty bonkers. Assuming 12% growth in free cash flow each year for the next 10 years, asking a 50% annual return gets you an intrinsic value of around $200 billion, whereas the current market capitalization sits around 8 times higher than that. So I don't want to annoy the Nvidia shareholders out there, but the company does seem very overvalued right now.
Now, New Money points out that, if you look at companies' valuations today, you can't take that as a one-to-one correlation to the future of these stocks and whether you're underpaying or overpaying for them. I laughed that he said Google and Meta are of the cheapest. That's why I was loading up on Google. And I'm still buying Tesla because, there's some speculation in their business in the future. Obviously, today, very expensive companies. But if Nvidia, for example, is so expensive, I mean, it's trading at a 75 times multiple and a $2.2 trillion market cap, for you to justify today's value, this thing is going to have to balloon up to about, I'm going to say, a $6 to $8 trillion market cap to start justifying a 75 times price multiple. So one of 2 things needs to happen here. We either need to get some compression from earnings, which means they have to justify this again, they have to basically triple up everything that they've done, or you're like paying for something you're never going to see a rate of return. Now, no one's saying that is not possible in the next decade. In fact, it's more than likely possible if these AI chips keep going the way they're going. But you have to recognize that these businesses are ebb and flow. Like, you're going to reach parity, you're going to run into issues. Nothing is as clean cut as investors seem to think Nvidia is. And that's where my concern came in. I've been saying this for a long time now, and a lot of people kept telling me, you're wrong, it just keeps going up, But the same thing happened to Tesla. It just kept going up, and then what happened? All of a sudden, the steam burnt out. The company couldn't grow at 50 or 100% anymore year over year. And when you start getting lower growth rates, you can't justify a 75 times multiple. And I'm very being conclusive that that's what's going to happen with Nvidia. Now, there's no guarantee that's going to happen. I'm not shorting it. I'm not buying it. And obviously, I'm kind of buying it because I still cost average into the S&P. And let's talk about the S&P in and of itself, because lately everything has been going to the moon. We just saw SEHD, and I'm really glad I got my dividend drip coming off that sucker that was reinvested. That got me like an extra several shares, I think. And we're sitting on $80 now per share of SEHD, and that's really helping propel VOO. And I want to tell you what I mean by that's really propelling VOO, because you notice the Qs have actually been lagging a little bit against SCHD. As of recent, you can see VOO is lagging against SCHD. So what's going on here? Like, how does the S&P keep making all-time highs when tech companies are so overvalued? And in fact, if you take a look at the 1 day of like the performing, stocks and this heat map here, let me zoom my head out of the way just to give you some clarity. You can see tech companies over the last day not really rallying a huge amount. Apple, after being so suppressed, kind of coming back a little bit. But we start seeing a lot of green in the whole other aspect of the market. And that's likely because people keep complaining about how expensive tech companies are. So the lower half of the market is kind of going up. And that, even though we're going to see tech companies like Nvidia trading down, and even though tech companies can sell off, if that money keeps flooding into the other half of the market, it continues to kind of offer some parity, right? You're not really going to see a correction if that money just rotates into other companies that sit in the S&P 500. If you just zoom out on the 1 week here, you'll start seeing a little bit more, not a lot of green in tech. You're seeing a little bit more kind of nullifying, a little bit of green on some tech companies, not a whole lot happening on other ones, but you're still going to see quite a bit of green, across the board on the lower half of the market. We zoom out into the 1 month here. This is where we're starting to see a lot of equality in the green. And especially if we zoom out on a 3 month here, we can see almost everything is pretty much green because, a lot of money's been flooding in across the board here. But what I want you to also pay attention to here is you look at Apple down 10%, Google, Meta's a bit of an exception. Nvidia is definitely an exception here. But when you take a look at some of these more common denominator stocks like Amazon up 17%, Microsoft up 12%, Oracle up 17%, Adobe's actually down, Apple down 10%. You look at some of these software companies like CRM and, even Uber's up 26%. But what's really intriguing to me is you're seeing the same kind of gains in things like Merck & Company and AbbVie and Eli Lilly. ExxonMobil's up 12%. You scroll down here and you look at JP Morgan's up 18%, actually outpacing a lot of the tech companies. MasterCard's doing very well. Home Depot's up in the double digits. You look at even General Electric here up 41%. You're looking at these industrials. Some of these industrials are just crushing it, right? So you're seeing a lot of movement in these stocks that are less talked about in the broader market. So you kind of have to keep in mind that, yeah, the S&P is trading at a high multiple today, but if those high multiple stocks start to compress to the downside, we get into an interest rate recovery or an interest rate cut cycle in the latter half of the year. The interest rate sensitive stocks are going to start to recover even more because they're going to be adding that to the bottom line. And I like seeing that, especially with SCHD, that it added the stocks that I really like a lot. It's kind of upper weighting Verizon, right? Verizon's, arguably an incredibly cheap stock heading into an interest rate cut cycle because a lot of that debt that's piled up on these infrastructure companies is going to start getting added to the bottom line. We're seeing them add things like Hershey stock, like a lot of companies that I was thinking about adding individually. That's why I love companies, or basically I love things like SCHD, because I think management does a beautiful job at kind of removing the overvalued companies and more or less focuses on stocks that are a little bit more suppressed, that likely have some better upside potential into the future, right? Considering Hershey's been absolutely devastated here. So, I'm always intrigued to see how the market is going to balance out, these higher valued stocks, because that at the end of the day is the question. Now, if we go into a full bear cycle, and in order for a full bear cycle to take effect, you would need all companies, undervalued, overvalued, to start seeing a huge correction. I don't know if that's going to be the case this time around. I do like the Canadian companies here a lot as well. A lot of the companies sitting in VDY will continue to rally, I think. They're doing exceptionally well here and still trading at more than favorable values, especially with oil starting to recover a bit here. So always keep that in mind. No matter how bearish these people get, the only thing that I can properly recommend is do what I do. Always keep 10, 20, maybe 5 to 10% of your entire portfolio in cash. And I don't mean your emergency fund cash. I mean your stock market emergency fund cash. And this just basically means that if the stock market corrects upwards of 10%, it's usually my rule of thumb. If we see a 10% correction, take that cash and double up your monthly contributions. Don't stop making regular contributions, just double them up when the market corrects, and keep doing that as soon as the market kind of dips to that 10% level, and buy all the way down and double up that buying. And then as it starts to recover, you can go back to normal buying, like just keep doing your regular cost averaging. But don't listen to these dudes that are uber rich, because they really don't take into the perspective of, what it's like to be a normal person trying to get to retirement. And if you think Meet Kevin day trading is going to help you, or listening to Jeremy, which at least anecdotally he offered some insight saying like, hey, I'm rich. You don't have to be as worried as I am. I just don't want my millions of dollars to implode like they did coming out of the pandemic rush, because the dude made a fortune and lost an insane fortune that I doubt he's recovered from. Just continue to cost average and always, always be buying. But I'll pass that question off to you. I'd love to know what you think in that comment section below.